Investors are watching earnings, of course, today, but also the drama surrounding U.S. President Donald Trump's plans for the Fed chair, Jerome Powell. Our guest says one guideline for investors here is focus on founder-led companies. Let's get more on that and other investment ideas. We're joined by Jack Ablin, Chief Investment Officer and founder partner at Cresset Capital. Jack, thanks very much indeed for coming on the show. Any thoughts on Trump and Jay Powell? Trump seems to be backing away from the idea of firing the Fed chief.
Yeah, that's true. Yeah, absolutely. Investors are watching the headlines. We heard Trump talking about firing Powell earlier today. Equity markets down, bond yields up, and then he came out and said he had no plans to fire the Fed chair, and we had a reversal. So bond yields coming back down incrementally, and as you mentioned, stock prices higher. To records or close to records in the NASDAQ. Yeah.
What are you going to be looking out for in this earnings season?
Sure. So, we want to see how potential tariffs will certainly impact expansion plans, hiring, spending, that sort of thing. We're also going to look at the passage of the Big Beautiful Bill and how that could impact some current spending and expansion. So I think, there's sort of what we'll call a conflict, if you will, of policies, right? We've got the expansionary effect of the bill with lower regulations and big incentives to spend and expand, mapped against these higher tariffs, which would essentially a national sales tax, if you will, on imported goods. And that's going to put pressure on profit margins and certainly crimp some demand.
You have some fascinating charts for us here. If we could get into one that shows as the market, the S&P 500 climbs to record highs, as it has over the past few days, EPS growth, profit growth has slowed. That sounds like a worrying sign.
It is. I mean, this is really why, for example, valuations are really starting to get stretched. We started the year with full year earnings growth at around 13.5%. That's now been cut to 6.5%. It's stabilizing a little. I'm hopeful we could get analysts to now start revising upwards. But you're right, that's a troublesome, worrying gap, if you will, between where the stock market is trading and where those underpinnings of earnings are situated. I do think it does reflect a big resurgence in investor optimism. If we look at, for example, widespread pessimism at the height of Liberation Day and all that uncertainty, bullishness was essentially the 0 percentile. I've never seen it relative to bearishness so low. And that was really fertile ground to bounce back. We're now back at what I'll call middle of the range levels of bullishness.
You have another chart for us showing the Mag 7 outperformance, though, in this respect. I mean, these companies, I know they have enormous valuations, but they have big profits as well.
That's it. I think one of the key drivers of growth of equities over the next 6 months or so is really going to be profit margins. And you're absolutely right. Mag 7, very scalable business. And one incremental dollar of revenue, virtually almost all of it drops now to the bottom line. Meanwhile, large caps, mid caps, small caps, those profit margins are flatlining, and we could potentially see those roll over if they cannot pass these higher costs along to their customers.
Tell us a bit more about your thesis on buying into founder-led companies. Meta came into my head. Mark Zuckerberg is still in the top seat. But you say numbers show that founder-led companies have been outperforming?
They have, and you're right. If you look at Meta, you look at NVIDIA, you look at Palantir, where we're looking at CEOs who are either founders or co-founders. This is research that's still ongoing. I don't want to suggest that we have an investment strategy around it yet. But, keep in mind, Paul, that we have, I'm sorry, Andrew, but we have our clients are CEO founders, right? Our clients have, started their businesses. They grew their businesses. Many of them sold their businesses and have become clients of ours. So that is resonates with our clients, and that's something we want to really pay attention to. So one of the things we want to do is let's look at Starbucks. How did Starbucks do under Howard Schultz versus under Brian Cornell? How did Apple do under Steve Jobs versus Tim Cook? Those are the kinds of things we're going to start really fleshing out to see if there's a strategy we can actually build around that.
You have some stock ideas for us. Start off with McDonald's, a staples provider, if ever there was one.
Yeah. So, Andrew, I would say the theme here is we want cash flow generating high quality companies that have a consistent dividend with some dividend growth. McDonald's is offering investors a 2.4% dividend yield, and we anticipate it growing its dividend 5.4% per year for the next 3 years. So very solid player there, McDonald's, and most of what they're doing shouldn't be too impacted by higher tariffs along the way.
Caterpillar, a classic cyclical.
Yeah, Caterpillar, 1.5% dividend yield, anticipated to grow at 7.1% per year over the next 3 years. Here again, mostly domestic production. And yes, it's an industrial, and I'm sure there are a lot of parts that could be involved with tariffs and the like. But it's a very solid footing and should continue to expand as, for example, mining here at home expands. And some other industrial development progresses.